All right, so a lot of people teach you the market maker model as it's very simple. They teach you like, okay, it has original consolidation, distribution phase one, distribution phase two, then smart money reversal, accumulation phase one, and phase two. But in reality, the actual market maker looks very different on the real charts, right? Now, this looks very clean, right? And whenever a newbie watches those videos where they teach you like the market structure is clean as this, and then they get confused when they go onto the live markets, right? Similarly, what the other gurus also teach you is a market structure. They tell you that the market structure looks like this, where you have very clean lower low, lower high, lower low, lower high, right? And in reality, the actual market structure looks like this, okay? It's gonna look something like this. So it's not as clean as they teach you. So that's exactly what this course is going to be about. I'm going to teach you how to actually identify proper market maker models. I'm going to teach you what exactly is a market maker models. We're going to go towards the sell side, and then we're going to teach you the buy side of the curve. I'm going to teach you entry patterns. I'm going to teach you my personal approach to the market maker models. I'm going to also teach you where to identify these models, where to identify high probability market maker models. So make sure you do not skip any part of this video, because if you do, you may miss crucial information. Now, and information about myself, I have been in the trading industry for 6 or 7 years now, and I'm currently funded with 5 prop firm accounts. I've helped hundreds of my students get funded and get their payouts. Okay, so rest assured you are learning from someone who actually knows shit about trading. All I ask from you in return is just hit the subscribe button and leave a like. That's it. So without wasting any more time, let's get on with the course. Okay, so here is chapter 1 of this course. And in this chapter, we're gonna learn about what exactly is a market maker model, right? So a market maker model is basically how the markets move, okay? This is how the market goes from a downtrend to an uptrend, or from an uptrend to a downtrend. And we can successfully predict each move, all right? So in the market maker model, essentially what we're gonna have is a original consolidation, okay? A consolidation period, and then afterwards price pushes down, all right? So price will consolidate, right? And then it will have a breakout. And then we're going to have another period of consolidation. And then we're going to have another push down or breakout, if that makes sense, right? So now when we have original consolidation, right, we are looking for a reversal, okay? Because whenever an original consolidation is formed, there is a bunch of liquidity above the original consolidation. The original consolidation where price started to consolidate in the very first place. So now, where do we look for reversals? Okay, we look for reversals on the higher time frame PD arrays. What are PD arrays? They're basically auto blocks, significant highs and lows, fair value gaps, and breaker blocks, and a lot of other PD arrays. But these are the main ones, and you should focus on them. So let's suppose that you mark out a significant low on the 4-hour time frame. So this is a 4-hour low, right? And price takes out the 4-hour low. Now what you want to do is you want to drop down to 15-minute time frame. So you're going to drop down to 15-minute time frame, okay? So this is where you drop down to 15-minute. And once the price has taken out the 4-hour low, what we are looking for is a original consolidation on the 15-minute time frame. So look, while the price was coming back into the 4-hour low, where was the original consolidation? Okay, so if there is a consolidation period before price came back into the 4-hour low, right, then we can look for a reversal pattern. Okay, then we can proceed with the market maker buy model. So whenever we are looking for reversals and we're looking for buys, that is called a market maker buy model. Now, a market maker buy model consists of a consolidation, sell side of the curve, smart money reversal, which is basically a reversal or market structure shift, and then we have our entries. But these entries are not as simple. The market structure that's over here, it's not going to look like that on the real charts. So don't worry, I'm going to teach you the real life, real charts examples as well. Okay. So it's very simple. You look for original consolidation, and then you also look for at least one more consolidation period before price comes into your 4-hour low or PD array. So there must be one more consolidation period or a pullback. Okay, so it doesn't necessarily have to be a consolidation phase. It just has to be a pullback. So we have a lower low, lower high, and then a lower low. Okay, and this period of pullback on consolidation is crucial. We must have at least one consolidation phase after original consolidation. So this is the original consolidation. Very good. And then we want to see another, right? If price just pushes down like this, right? Like for example, like this, then it is not a clean market maker model. So you simply look for a market structure shift, right? And then you mark out your PD array. So your first entry is going to be low risk. Okay, so let me just type this, low risk entry. So the first entry is going to be low risk. So for example, if you usually risk 1% per trade, you will be risking 0.5% here. Okay, and our target is going to be the high of the original consolidation. Okay. So this is going to be your target, the high, and then you can actually anticipate taking a long position here, and then you have your second accumulation entries, right? And I'm gonna get into those later in the video, but essentially this is what a market maker model looks like. In summary, you have original consolidation, consolidation phase 2, and you can also have consolidation phase 3, which is right here, which is actually a pullback. So we have 3 total consolidations, and original consolidation, number 2 and number 3. So it is not necessary to have a third one, but as long as you have 2, you should be fine. So you look for a shift in the market structure, entry, and you target these levels. So similarly, if I flip the chart over, it will look the same when we are looking for sells, right? So essentially you would have a buy side of the curve, right? So you identify original consolidation, right? But after you identify it, after price taps or takes out a 4-hour high. So this is going to be a high. So let me just do this. I'm going to put it like that. And it looks the same, exact same. Okay. Now there are several ways to enter, right? I'm going to teach you in the next chapter on how you can take the entries, because trust me, it's not as simple as it looks like this. Okay, it's not simple. You take your entry and price is always going to push down. There are ways to take entries. Okay, so essentially this is all a market maker model looks like. Okay, original consolidation, and then you have, you know, consolidation phase 2, and then price goes into your PD array, high time frame PD array. You drop down to 15-minute, you identify original consolidation, look for a smart money reversal that breaks and gives you a market structure shift, low risk entry, 0.5% here, and then after you get another break in the structure, you go 0.5 more, so that's like 1% in total. So let's move on to the next chapter now. All right, guys, so this is the chapter 2 of this course, and in this chapter, we are going to learn about how to actually enter and how to actually take high probability trades, because even if you identify the market maker model, there is no guarantee that you are going to win every trade. But to increase the probabilities of each trade, we have to look for certain patterns. All right. So if you look at this price action, you might be confused. Okay, what the hell is this, right? And it's totally understandable, but I'm going to teach you everything. So now there are 2 ways to take your entries, and this is the first method. Okay. So whenever you get your price to go into your high time frame PD array, so for example, one more thing I want to say is that this is fractal. So this works on all time frames. So for example, you could mark out the daily time frame PD array, and then you can drop down to 1-hour time frame to look for the setups. Similarly, you can mark out the weekly time frame PD array, and then you can drop down to 4-hour time frame to look for your entries. Okay, and then you have your 4-hour PD array, and then you can drop down to 15-minute time frame. So that's what I'm showing you here. So price goes into the high time frame PD array, which is 4-hour auto block, fair value gap, or any high or low. Now, when you get a market structure shift and you have marked out your original consolidation on the 15-minute time frame, right? So when price went into the PD array, 4-hour PD array, we drop down to 15-minute time frame, and then we identify original consolidation, right? And then we look for another consolidation period or a pullback, right? And then we look for a market structure shift. Now, once we got the market structure shift, right, there is a thing called low risk entry. Okay, so this right here is a smart money reversal. We have shifted the market structure, right? And then the first entry, right, is gonna be through this fair value gap that forms. Okay, so this is going to be your entry over here. Now, once price goes further down, right, you may be confused, okay, where to enter now, because price, what will price do is basically, if you, let's suppose that we get another break of structure, right? So we have a break of structure here. And a lot of people would try to take their entry from this fair value gap, and it doesn't work like that, okay? Price will go up ahead and take out buy side liquidity. So once you get the low risk entry, which is going to be 0.5% risk, to enter once again, right, you have to look for A, B, C, D pattern. So we have a lower low, lower high, lower low. Once that forms, we are looking for a purge of the lower high. So we have a lower high here that gets swept. Now, this is where the third time frame comes into play. Okay, so this is where we're going to drop down to even lower time frame. So this was the 4-hour time frame PD array. Then we got a market structure shift on the 15-minute time frame. You can take your low risk entry on the 15-minute time frame, and that's totally perfect. But then when price creates a lower low, lower high, lower low on the 15-minute time frame, we are looking for a B, C, D purge. So the lower high gets purged. Now, once that happens, right? So let me just go here. Once that happens, right, over here, you drop down to 1-minute time frame. So we go from 4-hour to 15-minute to 1-minute time frame. 1 minute, remember that. And now we are looking for a market structure shift. Now, once we get that, you can simply identify original consolidation on the 1-minute time frame now. Okay, so another market maker model is going to be presented inside this price action. Okay, from this low to this high over here. So right here, you can identify original consolidation. If there's no original consolidation here, that is totally fine, okay? But the most important thing is that you look for this type of liquidity sweep. Lower low, lower high, lower low, sweep, and then we drop down to 1-minute time frame. We look for another market structure shift, and then we take our entry and we target this low here, which would be this low here. Now, similarly, you can see that once we broke this structure, we created another lower low, lower high, lower low. Now, a lot of people would try to enter from this fair value gap, but what's going to happen is price going to take out the liquidity, the buy side liquidity. So when we are in a sell program, the price will seek buy side liquidity. So after price sweeps the buy side liquidity, it's going to push down, okay? Price will never, ever constantly go in this manner, okay? This is what the gurus teach you, that that's how the market structure moves. But in reality, when we are in a sell program of the market maker model, we are looking for buy side liquidity purge in a B, C, D pattern, or lower low, lower high, lower low, sweep, and then a lower time frame market structure shift. And then you would do the same. You would drop down over here. You would drop down to 1-minute time frame, look for a market structure shift, and then you would target this low over here. You do not need to target this, okay? We can keep taking entries as long as the original consolidation is still intact. So make sure you remember that. And similarly, you can see that price went up ahead and swept the buy side liquidity once again. Okay, and a lot of people would try to take their entry from a fair value gap that forms here, but price will sweep the liquidity. And then you drop down to 1 minute time frame, look for the same pattern, and you take your profits until this level is hit. And similarly, you would do the same if we were in a buy program. All right. Now this is method 1. Okay. Now let me teach you method 2. Okay. So let me just remove drawings right there. So let's assume we have original consolidation, pullback 1, and then we have a market structure shift. So this is going to be, and let's just do this, your higher time frame PD array. So now this is on 2 time frames. We will not be dropping to the lower time frame. Okay, so for our auto block, 15-minute market structure shift, the first entry is going to be low risk. Now there's a thing called mitigation blocks. What exactly is a mitigation block? So while the price was coming into your 4-hour auto block, price created bullish auto blocks. So when price was in a buy curve, or when price was coming into the 4-hour auto block, it was going up, right? And while it was going up, it created bullish auto blocks. So there could be a bullish auto block here, right? Could be a bullish auto block here, a bullish auto block here, right? So now we can utilize these old auto blocks. And what I mean by that is whenever, so this is your low risk entry, whenever price closes below the old auto block, a bullish auto block, remember that. And also when price closes below it and forms a PD array inside this auto block. So let me just disable this real quick. So let's assume there is a fair value gap that is in alignment with this bullish auto block that was in the buy side of the curve. We can take our entry from that fair value gap. And you can put your stop somewhere around here. Now, similarly, if price breaks below this old bullish auto block once again, and inside this old bullish auto block, we form another PD array. So this could be a auto block that forms on the over here, right? We can simply take our entry from that auto block, right? And we can put our stop above here. And similarly, what can happen here is price forms a fair value gap once again in this old bullish auto block. So it's going to be somewhere around here. And this could be your entry, and you can target the low of the original consolidation. Now, a key thing to note is the highest probability trades are going to come above the 50% of the range from original consolidation to the last high that was formed before market structure shift. So your high probability trades are going to form above the 0.5%. Okay, so for example, this entry would have been perfect because this entry was above the 0.5 level, or in fancy words, right, it was in the premium. And similarly, that would be the case here as well. So basically, this is how you take your entries. Now, to even make this more high probability, right, instead of taking your entry directly from here, you would apply the same method of dropping down to 1 minute time frame. So let me give you guys time frame alignment. So if you are a swing trader, you would drop down to, first of all, you would mark out your weekly high time frame PD array, and then you would drop down to 4-hour time frame, and then you would look for a market structure shift on the 4-hour time frame. Your low risk entry would be on the 4-hour. And then to drop even lower, you would go to 15-minute time frame for confirmation entry. So for example, if this was the 4-hour mitigation block, and inside the mitigation block, another PD array formed, you would then drop down to 15-minute time frame, and then you would look for this pattern, right? And then you can target, this low over here, and similarly you would do the same here, and it would look something like, something like this. Price goes down, and something like, this. So I hope that clears it. This is basically how you take your entries. Okay. So yeah, you utilize old bullish auto blocks, or in this case, old bearish auto blocks, right? And you keep taking your entries. So this is it for this chapter. Now let's move on to another chapter. Okay, so this is chapter 3, and in this chapter, I'm gonna teach you how to identify, how to actually find these market maker models on the chart. And I'm also gonna go into detail into ERL to IRL and IRL to ERL. So a very easy way to identify a market maker model, right, or original consolidation is through ERL and IRL, or IRL to ERL. Now, what exactly is ERL? ERL is external range liquidity. So basically any high or any low. So this high is external range liquidity, and this low is external range liquidity. What is IRL? IRL is internal range liquidity. So any fair value gap is considered to be internal range liquidity. Now, why is that? So let's assume that you look at this pattern where price takes out external range liquidity, and you also have internal range liquidity over here. Now, one thing that you should note is price only does two things. It goes from external range liquidity and it goes back into internal range liquidity, or right, it goes from internal to external. This is very simple. Now, why does it happen? So let's assume that you're looking at this on the daily time frame and you have marked out the IRL, okay, internal range, and price has taken out external range. So by the theory, we know that price, when takes out ERL, it goes into IRL. Now this is on the daily time frame, and you have marked out the IRL. Now if you drop down to 1 hour time frame, right, this is what the market structure is going to look like. Okay, so the fair value gap that I have marked out on the lower time frame, it is original consolidation 90 to 80% of the time. Okay, so IRL, when you drop down to lower time frame, you will find out that it has original consolidation. Okay, that's where the original consolidation forms. So let me just yeah, do this like that. So this is when you drop down to a lower time frame, you will notice that this fair value gap is original consolidation on the 15-minute time frame. So this is 4 hour or daily time frame. So let's assume this is a daily time frame. And when you drop down to 1 hour time frame, right, you will find original consolidation here in this fair value gap. The fair value gap by itself on a lower time frame is original consolidation. So your problem of identifying, market maker models is gone. All you need to do is look for one more consolidation phase when you drop down to, your lower time frame, or a simple pullback. And then price takes out ERL. Now you can see that once price takes out ERL, we are simply dropping down to a 1 hour time frame. And you will notice that this fair value gap is original consolidation. And then on the 1 hour time frame, we are looking for a market structure shift, and we are targeting the original consolidation, which will 90% of the time will also be original consolidation. So very simple methodology that you can use. Now, if I remove this real quick, right? Similarly, what you can do is, by now we know that price goes from IRL to ERL, or from ERL to IRL. Now notice this high over here. There's 60 to 70% chance that this high is where the original consolidation is going to be. And from this fair value gap, we can drop down, to a lower time frame. So let's assume that this fair value gap is a daily fair value gap. And then we drop down to 1 hour time frame. We simply look for a market structure shift. Once we get the market structure shift, our bias is confirmed. The price will go towards the ERL. And when you drop down to a lower time frame, you will notice that around this high, there will be original consolidation, some form of consolidation phase 2, or just a simple pullback, and then price goes into your IRL. And from there, we anticipate a reversal, and then we take our entry and we target the high, which would be the original consolidation. So very simple method to identify the market maker models. Very simple. Okay, so now what I'm going to do is I'm going to teach you my personal model and my personal approach to market maker models. And then I will give you examples for that personal approach. All right, guys, so this is the chapter 4 of this course. And in this chapter, I'm going to teach you my personal approach to market maker models. I'm going to teach you how I identify market maker models, and I'm going to teach you how I take my entries as well. So there are 2 ways, all right? So the first way is I use the ERL to IRL method. So what I do is on the daily time frame, I'm looking for price to take out any form of ERL, so basically any low or high. So in this case, you can see that this low was taken out. Now what I'm doing is I'm identifying a IRL or a fair value gap inside the dealing range. So dealing range is from this high to this low over here. I'm not looking at fair value gaps here, okay? I'm not looking at IRL here. I'm looking at the fair value gap or IRL inside this dealing range from this high to this low. So once I have identified the, a fair value gap inside this leg, it could be anywhere. And on the daily time frame, the ERL was taken out. Now I'm dropping down to 1 hour time frame. Okay, so I'm dropping down to 1 hour time frame and I'm looking for a market structure shift. Now, once we get the market structure shift, right, that confirms the bias that we are going to go up ahead and fill out this IRL, which is basically a fair value gap. Now, I'm not taking my entry straight away. I'm not taking my low risk entry. I'm waiting for A, B, C, D pattern on the 1 hour time frame. So to repeat, on the daily, we took out ERL. We had IRL on the daily as well. Now, once the ERL was taken out on the daily, we dropped down to 1 hour time frame. And afterwards, we looked for a market structure shift. The market structure shift confirms the bias, but we're not going to take our entry now. I'm waiting for a higher high, higher low, and then a higher high formation. Now, once I get this formation, I'm waiting for price to take out this low over here. Now, do remember that this fair value gap is going to be original consolidation on the 1 hour time frame. So there will be a consolidation phase around this area, because remember, higher time frame fair value gaps are just consolidations on a lower time frame. Okay, so once we get a market structure shift and we have a higher high, higher low, and then a higher high pattern, I am simply waiting for a B, C, D liquidity purge. So on the 1 hour time frame, once the liquidity is purged like this, so we have a market structure shift, and then we have a higher low, higher high formation. I am then dropping down to 5-minute time frame. So we go from daily to 1 hour to 5-minute time frame. Okay. Now on the 5-minute time frame, once this low was taken out, once the A, B, C, D purge was successful, we are going to look for another market structure shift on the 5-minute time frame, and then we're going to take our entry. And we are going to target this high over here. Okay, so this high over here is going to be our take profit, this 1 hour high. So remember, on the 5-minute time frame, there will be some form of consolidation around here. So that is going to be your 5-minute market maker buy model entry. And then Finally, after we get a market structure shift on the 5-minute time frame, after a 1 hour A, B, C, D liquidity sweep, we are looking to take our entry from the fair value gap. And we are going long just around here, putting our stop right below the low, and we are targeting this high over here. So I'm going to keep on doing this. So let's just go here. I'm going to keep on doing this until the daily fair value gap or the daily IRL has been reached. So I'm going to go to 1 hour time frame once again. I'm going to look for this pattern once again. So what do we have here? We have A, B, C, D, or higher high, higher low, higher high, and then a liquidity purge of this higher low. And then we drop down to 5-minute time frame, and then we look for another market structure shift, and then we take our entry and we target this high over here. And we keep doing this until this level is reached. And similarly, you would do the same when you're looking to take short positions. Okay, it's the same exact thing. So now that I've taught you my personal approach number 1, let me teach you my personal approach 2. So in this case, I'm not using ERL to IRL methodology, all right? I'm simply using PD arrays to frame my trade. So on the daily time frame, right, I am marking out PD arrays. So it could be a significant high, could be a significant low, could be a auto block, or could be a fair value gap in the discount or premium. So let's assume that this right here is an old auto block, and price on the daily time frame, right, comes into this auto block on the daily time frame. Now, once price reaches into the daily auto block, I am dropping down to 1 hour time frame. Okay, I'm dropping down to 1 hour time frame, and then I'm looking for a market structure shift on the 1 hour time frame. Okay, so now when you drop down to, let me just do this. So when you drop down to 1 hour time frame, you have to identify original consolidation. All right. So over here, what you can see is we have the original consolidation on the 1 hour time frame. So when price reached into the daily auto block, we drop down to 1 hour time frame, and then we identify original consolidation, and then consolidation phase 2, or simply a pullback, and then we are looking for a smart money reversal or 1 hour market structure shift off from the daily auto block. Now, once we get the market structure shift, I'm simply taking my entry, low risk entry, from the 1 hour auto block. I'm not dropping down to 5-minute time frame. However, when price gives you your initial entry on the 1 hour time frame and then creates another higher high, so we have a higher high, higher low, higher high. Now I can drop down to 5-minute time frame. Okay, so I'm just gonna look for a same ABCD pattern liquidity sweep. So we have ABCD, a purge right here. I'm gonna target this high, right? So on the 5-minute, I'm gonna look for a market structure shift. This is gonna be my entry, and I'm gonna keep on doing this until the high of the original consolidation is taken out. Now, to clarify, what I also do, there's a bonus approach, is I sometimes use IRL to ERL. So for example, I would do the exact same thing, right? But instead of, taking my, setups from ERL to IRL, I will be looking for the same exact thing when price reaches into the daily fair value gap, and then we have the daily ERL. Then the same setup would apply: 1 hour market structure shift, then 1 hour ABCD liquidity sweep, and then 5-minute market structure shift. I'm gonna keep on doing this until this high is taken out. Now that I have explained you my personal approach, I'm gonna give you guys some examples, all right? And that is going to clarify each and everything, and that is going to be the last chapter of this course. All right, guys, so here is example number 1, looking at NZD USD. And over here, what you can see is we have the IRL, and then we have ERL, okay? So what price is gonna do is gonna go from IRL to ERL, or from ERL to IRL. So if I push through this, you can see that price tapped into the IRL. So we're gonna take our trade from the IRL to ERL. So now that the price has come into the daily IRL, I'm going to drop down to 1 hour time frame, right? And over here, you can see when we tapped into the 1 hour IRL, we had a market structure shift. Now, according to my personal approach, I'm not going to enter right now. I'm looking for A, B, C, D purge. I'm looking to take my entry during London or New York session, okay? So we do have A, B, C, D purge, but we are waiting for London sessions to start, okay? So we're not going to take our entry right now, but as you can see, just around here, so let me just delete this so it's clean, right? What do we have? We have A, we have B, and then we have C. We have a higher high, higher low, and then a higher high, and then the A, B, C, D liquidity sweep. Now I'm going to mark out this high over here, although our daily target is here, but we are going to target these highs over here. So if I drop down to 5-minute time frame now, you can clearly see that we have the original consolidation just around here. So price consolidated here, created these relative equal highs. And now that we have taken out the higher low on the 1 hour, we are simply looking for a market structure shift. And this is going to confirm the shift in the structure, and we have it right there. Now we have this auto block here, so we can look to take our entry from this auto block, stops right below this low, and we can target these highs or original consolidation here. Okay, so notice this, we have original consolidation, and then we have a pullback, right? And then we go into the higher low, smart money reversal, and now we're going to take our entry. So you can see that price did not take out this low over here, so we are well and good. And if I play this through, you're going to see that the take profit level was successfully hit. So this is very simple, and this is my personal approach. So now let me give you guys a couple of more examples. All right, guys, so here is example 2, and this is my second approach. So for this, I do not use the ERL and IRL methodology or 3 time frames. I only use 2 time frames, and I'm looking for like significant key levels to take my entry from. So on the daily time frame, you can see that we swept this significant high on the daily. Now all I need to do is identify original consolidation inside this move on the 1 hour time frame, and that is going to be my target. To make things easier, what I can simply do is mark out fair value gaps, and inside those fair value gaps I can identify original consolidation that could be my target. Okay, so I hope that makes sense. So now if I go to the 1 hour time frame, right, and you can see that I've marked out this fair value gap, and you can clearly see we had the consolidation period just around here. Okay, now of course that was a fake out, and then but this is the original consolidation. Then we have the consolidation phase 2, and then we have the phase 3, right? And then afterwards, after price tapped into the significant daily high, we were looking for a smart money reversal. That would be here. Now, a lot of people consider wicks, and personally, I consider wicks as well as market structure shift. But if you want to be safe, extra safe, just wait for a body closure. Now, once we got the market structure shift, we have this for auto block, so consecutive bullish candles. So this is going to be your entry somewhere around here. Your stop would go right above the high, and you can easily target this fair value gap. So in other words, if you really think about it, although I'm saying that I didn't use ERL to IRL, but it was simply ERL to IRL, but on 2 time frames. So I used the fair value gap theory that a original consolidation can be identified on higher time frame fair value gaps, and that's exactly what we see on the 1 hour time frame. So that's what made the things easier for us, right? So we got a market structure shift, and price just pushed through these original consolidation, and price will always take out the lowest point of the original consolidation. So this right here is a big chunk of consolidation period, and price successfully took it out. Now let me give you guys one more example. All right, everyone. So here is the last example. If you are looking for more examples, I'm going to link some videos in my videos description so you can check them out. So if you want more examples and want to, improve your understanding of this concept, then there are videos in this video's description so you can watch after watching this video. So CAD CHF on the daily, we took out external range liquidity, and on the daily time frame we had internal. So we go from ERL to IRL, right? So let's see what happened when price took out the ERL. So if I go to the 1 hour time from here, you can see that we had a market structure shift, right? Just around here. But we didn't create a lower low, lower high, lower low formation, which is my personal approach to this model. Now over here, you can see that we swept the liquidity again, and then we had a shift in the structure again. But once again, we didn't create a lower low, lower high, lower low pattern or ABCD pattern, right? And you can see this would have saved you a couple of losses. However, when you see here, we got a shift in the market structure, right? And then somewhere around here, you can see we formed a B, C, and then D pattern. All right. You can see that we broke this low, lower high, lower low. And then afterwards, what did happen? We swept this high. And if I go and mark this out, this would be your target. So let's go here, right? Our high time frame IRL or daily time frame IRL is still intact, so we can take entries. So if I go to the 5-minute time frame, you can see that we have our original consolidation just around here, right? And this is going to be our target. So what happened? We swept the lower high. We got market structure shift. We have this beautiful auto block right here. This could have been your entry. Your stop would go above here and at least 1 to 2 registered watt. And that was absolutely beautiful. Once again, I'm repeating, there are a bunch of examples that I have already given in my old videos. So you can just go ahead and watch the videos that are linked in the video's description. Thank you so much for watching, and please rewatch this course again and again to get a better understanding of this concept. Thank you for watching.